Now it comes ripping right back, gets really tight, has another little shakeout here, and then really tightens up right really nicely. And see, now once you're able to go through that process of tightening and having those shakeouts, the supply's gone. And that's why this can happen. 12 out of 13 days up, it just comes ripping back, because at this point, that is when you got the supply out of the stock. You got to get the supply out of the stock. That's the key to watch for, is to get good at watching the stock and deciphering when supply has stopped coming to market, because at that point, the stock could be very explosive. Let's see here, let's look at another one. This was Spirit Airlines. This was David and Ryan and I were watching this stock for a while. This is when I used to actually talk to David quite often. We were on Skype like every day, talking about stocks sometimes, throughout the day. And I remember we were watching this name, and it had tried to come out of this base, but then it came off and it started looking like it was failing, but it tightened up here. And this was back actually when I was using load sheets, and Dave was still a little skeptical about load sheets because of the supply. And since then he's come around with the cheat areas quite a bit, and he uses it. And so I was explaining to him on this particular stock that I thought that we could maybe come right from this little tight pivot right here, and that was a place to start buying. And I bought some right here, and it moved right up nicely. 5 days up. You had 10 out of 11 days, and you see it never set another pivot. So you had to use that load sheet to get on board. But this was a form of a setup. This is a pivot. This is a pivot failure. You come out here and the pivot fails, and then you set up a cheat. So you're always going to be looking for the load cheat, the handle, some type of volatility contraction. Even if it's a reset, you're still going to be looking for the volatility contraction. At least I am. I'm always looking for the volatility contraction. Mark is always looking for the volatility contraction. David Ryan is always looking for volatility contraction. That's where William O'Neill was always looking for volatility contraction, because, and again, to give credit where credit's due, the concept of supply not coming to market, of analyzing a chart to learn or to uncover where supply diminishes, is Bill O'Neill's. I mean, I had a conversation with Bill O'Neill in person, and he explained this to me, and I did not get it for a while. And when I explained it, Bob Weissman, when he first started working with me, he was trading, I was explaining it to him, and he didn't get it for quite a while. And I said, well, I didn't get it either, so I don't expect you to get it completely. It took me a while. And then when I finally realized what was actually going on here, I realized, wow, this is so fundamental. This is just simply supply and demand. That's it. We're just trying to find out where there's high demand and not much for sale. No different than any other auction market. Spartan Motors. This is one that Spartan Motors, I traded back in the 80s, and then it set up here in 2016. So again, this is a very creative, I would say. I stuck a creative one in here. You came off of this load sheet here, a smaller base, but you had a quick shakeout, and then came right back and it tightened up. Look at it. Look at the little pivot it forms right here, and then bang, comes out really fast. We also call these, sometimes they don't even pause very much. They just shake out, and then within 3 or 4 days, they go right back into new highs, and that's a much harder one to get on board. We call it a Hardaway crossover. For those of you who don't remember, Tim Hardaway was a basketball player, and he had a really mean crossover. He would go left, right, and he was gone, and he would shake and bake players. That's what a stock can do sometimes. Once it gets that last shakeout and those weak hands are gone, boom, it's just free to go. So, but without waiting for a pivot, your chances of success, your probabilities go down, and the chances for volatility that will shake you out of the stock go up. So we want our probabilities to be the absolute best. So we always wait for that pivot point to develop. At this point, we're going to move to the second volume. So you're going to be going to the other workbook, whether you printed it out or you have it electronically. We are going to go to that workbook. I hope you've been taking notes. The best way is to print it out. I know some people do it digitally and can take notes digitally, but it's really important that you do take notes. We're just going to go right into the next section. And before we do, I want to just recap real quick of the things that we talked about. So we started off with categories and catalysts, right? We're talking about the various types of stocks and industry groups, and the way that we analyze these various different areas: the market leader, the top competitor, the institutional favorite. The turnaround situation could be a little bit different, right? If it's a biotech, earnings aren't going to be nearly as important as some kind of growth company. If it's a turnaround situation, we're going against easy comps, so we're going to have big earnings in the most recent quarter. So the tactics are applied a little bit differently depending on when we identify what category we're in. Valuation takes care of itself if the earnings are there. If the earnings, and the bigger the earnings, the more that the valuation doesn't matter as much, because it's because you can't really value it. You can't value a company that's growing at 100 times earnings. It'll have a PE of 500, because the earnings are growing so fast that PE can go from 500 to 50 in a matter of a few quarters if the earnings are strong enough. So the PE is not a very good measure of value when you get into very high growth. If you're getting into really, really low growth names that are big cap companies, it has a little bit better. It's maybe useful to a certain degree, but even then, not really. Fundamentals, remember, we only talked about three things: earnings, sales, and margins. That's all I look at. That's essentially what Bill O'Neill looked at, David Ryan, Mark Ritchie. We're growth investors. We're looking for growth. We're looking for a company that is very simple. The stock market is not like some special set of business principles that's different than any other business. We're looking for businesses that are making money, making revenue, and making profits. It's just like if you were to go buy a business, you'd look at it and you say, "Wow, this business guy got a great product. They're selling a lot of the product, and they've got nice profit margins. They're making a lot of money." If that's the case, company's going to be worth more money. It's going to grow. But the thing is that we know that the stock market is a discounting mechanism, and there's a lot of intelligence in the stock price, because you got a lot of smart people analyzing these companies. So that's baked into the cake. They're looking out. They can only see so far, though. That's why the real strong earnings, they can only see so far, but a lot will be baked into the cake. So that's why we have to use price and volume and make sure that the stock is performing, differential disclosure, that everything makes sense, right? And then finally, entry points. We talked about entry points. Now we're getting into really honing down, and we're starting to go to from that satellite, aerial, overhead, to actually getting under the microscope here and really we looked at the confirmations and violations, not only the entry point, but then what to look for after the entry point, whether the stock's acting right or not acting right. And then, okay, so it's not acting right. Well, we keep our eye on it. We keep our eye on it because it might reset. The fundamentals might still be there, but it just wasn't. I call it fundamentally sound, but not price ready. Okay, it could be a fundamentally sound company, but is it price ready? Because why? We want the right price. We don't want the lowest price. We don't want the earliest price. We want the right price. The right price is the price that just before it takes off gets us at a profit. So we're making money, and we're doing it with the least amount of time. All right. Okay. So that's a summary. I think I did a pretty good job off the top of my head there. Let's move on to the primary base. So the primary base. Now, well, let me just say this. There's two very important opportunities, or big opportunities, that you get in the stock market. One is what we call a potential magnitude opportunity, or magnitude play. The other one is what we call a velocity opportunity. So the magnitude is the primary base. And the reason why is because you have the opportunity to get the biggest move out of a stock, because it's the earliest that you can get on board, because the stock just recently came public. So it's the earliest in the life of the stock. So I turned it a magnitude opportunity because you could make the biggest move. And when you go back and you look at many of these companies that are household names now, like a Yahoo or a Google, Microsoft, any of these names that all of us would know, Amazon, Netflix, they all had an IPO at some point, right? And almost every one of them gave you an opportunity to buy them from a VCP, from a sound base, and from a systematic approach, pretty early in their cycle, pretty in their life cycle. Usually within the first time they formed a base, or within the first uptrend, very early on. So we call this a primary base. The primary base is the first buyable base after the IPO. Buyable, that's what's important. So it has to set up a VCP. So let me show you some of the names that I was buying, and where I was buying them, and the setup. Yahoo, we've talked about this before. This was the first time that I had bought Yahoo. I took this. I was in New York City at the time, and I was advising some of the biggest institutions in the world. And I took this stock to a lot of my clients, and no one wanted to touch it because it was trading at 938 times earnings right here when I was buying it. So you can see it broke out. It had 2 days of pullback, and then what do we get here? What's that? Tennis ball action, right? Rips right back, acting perfect. This stock went up almost 8,000% in just a little over than 2 years, in a little more than 2 years. I did not hold it for that big move, but I traded it a whole bunch of times. And from this point right here, I made over 100% the first time, and the second time I made over 100%, and then a few other times I made 60 and 30, and really strung together a really nice gain from this. Let's take a look at Amazon. This is the first time I was buying Amazon. Again, it went IPO, fell apart, and then took some time. And then finally, it formed this nice little tight pivot on this right side, and I bought it right here, coming out right here. This stock went up almost 80,000%. If you just put this one away in the lockbox, it would have, given you a nice retirement. In just 16 months, 2,500% from here. So really a great buy point here. Just recently, not too long ago, this company, and the symbol was BLTE, set up almost in identical fashion here on this right side. So take a look at Amazon. Take a look at where that's set up right here, and now look at this one. Almost identical, almost identical. When I saw it, I immediately thought of Amazon. This stock rocketed. I don't know if it's going to turn out to be an Amazon. I think since then it's come in quite a bit, but this stock rocketed off of that pivot point and went up almost 200% in just 21 days. So again, real powerful. See, all the supply is gone, and when you get that supply demand imbalance, it's a rocket ship, right? Let's show you another one here. Starbucks. Now keep in mind, at the time, you may say, oh yeah, Amazon. No one knew Amazon, and everybody hated Amazon on Wall Street. Absolutely, they hated this stock. The word on Wall Street was that Amazon would never make money, and you would never make money on the internet, which turned out to be completely as wrong as you possibly can get. Starbucks, all these companies that now everybody knows, when I was buying many of these, nobody knew these names. Microsoft, even Costco Wholesale. Nobody knew Costco Wholesale when I was buying it in 1991. So again, but you can see every time you get a VCP opportunity, you get a VCP opportunity even right off the IPO. DIX, we already talked about that. I had some analysis here on DIX, but here's a good another point here, because David Ryan, when he used to do the Master Trader program with me, he used to always bring up this point, that some of the best IPO opportunities happen in bear markets, and they happen. You should look for the IPOs that came public off the lows, or when the market's down big, because the stock market is a business just like any other business. When the market's doing great, they can sell anything. So they start selling all the crap. All right. And on top of the valuation, they can get a much bigger valuation because everybody's hungry for stocks. They'll buy anything at that point. But then when the market's down and conditions aren't right, now the belt gets tightened, and you can only really sell some really good merchandise. It's just hard because people won't buy anything, and the valuation, you're not going to be able to ask the big valuation because again, everything's tightened up at that point. Everybody's tightened their belt, and conditions aren't good. So always look for the 96% of stocks that make big moves come out of correction. So you want that also goes with IPOs. You want to look for stocks that have recently IPO'd, and you're not looking to buy the IPO. You want to wait until it forms a VCP. You still need to time those stocks from a low risk entry point, but that's the best time to be looking for IPOs. And many of these came out of market corrections. I'll show you a couple of others. These are all stocks that I was buying. So Abacus Direct, Again, 450% in 28 months, right out of here. Perfect, absolutely perfect VCP. You see it just tightens, tightens, tightens. So it gets really tight right here. And here's the weekly. You're going to see the same thing on a weekly. All right. So whether it's a daily chart or a weekly chart, you're going to look for the weekly to look good too. Now, look at the weekly here. See the big bar? Look at the big demand off the lows. That's exactly what you want to see. That's institutional demand. And now what you're waiting for is once you see that institutional demand, you're just waiting for the supply to quiet down, to get rid of those weak hands so you can get back in sync with that big demand. A few more. Borland, traded this one right here. I'm not going to go through every one here. Let's move down a little bit because there's a lot. I'm giving you a lot of these examples, more than we're going to go over, jumping forward here, because I want you to have a bunch of precedents. I want you to use this workbook as a model book where you've got the precedents, and now you can look for stocks that look similar, and you can learn what these are supposed to look like and the concepts. Ollie's, we talked about this before. I was buying it right here. And then I added to my position right here because it got even tighter. It got really nice and tight. David and I were, Ryan and I were buying it on this day right here. We were both buying it on this day, and I had previously bought it right here. We were both watching the stock, and I bought it a little bit earlier as it just started turning up, and then he came in there and bought it, and we were both buying it on that day. I'm pretty sure we were on Skype together on that day. I remember. But again, you see, you had a market here where you actually came off here. Remember I talked about you have some of these rallies and bear markets or corrections, and then they fail. It's exactly what happened here. Market rallied, and then it rolled over, but that's where we got the sore thumb. The sore thumb stuck out. Look at the relative strength line. It just blasts off, and it goes screaming into new high ground during a corrective phase. The market takes out the lows, but you're making higher lows. While the markets has all this volatility and everybody's all bearish here, you've got a perfect, picture perfect, absolute aces VCP setting up. Mark, does it get any better than this?
No, I was buying it right alongside you there as well. I was just going to say too, in my experience, sometimes these take, and you're probably going to show the LinkedIn and, some of the other examples. Some of these can take a year or two even, where the stock it builds this bigger base. I think this one was maybe, 6 or so months. They're again, the institutions, sometimes when these stocks come public, you got, people who were in the thing prior that are selling, and other folks are buying, and the stock's noisy. And then while these institutions start accumulating, you can see in a couple of these examples up the right side, look at all those blue bars. And then to David's point, sometimes the market is helping you. That weakness in the market is a great sign if this stock is, or these newer stocks are holding up. I remember this one particularly because David was I can't remember, he was on a call with MPA or something, and he said, you realize these guys, I think it was Ollie's that had I think they had 100 stores, and they had plans to do, 500. Every single store was profitable. David had done more work on the fundamentals. I think you and I were just looking at the technicals going, This is a perfect base. We don't care. We're buying it. But it all came together at that perfect time. And this was one of those names too. You bought it and you were just under no pressure. It was everything. This is a perfect example of how everything works together from what we've been talking about from the first almost minute to right here where this stock sets up.
Yeah. So two things. One, David came to he flew to speak at the Master Trader program when we were doing it in person. And David and I went to Ollie's to go see the stores in person. So that was doing some,
maybe that's what it was. Yes, I remember
kicking the tires at the highest level there. So take a look here though. Look at the contrast. Look at the volume contrast. So it comes way down in that little tight pivot. So you get the real tight action, and then the 1-2 punch, the big volume comes in. Again, it's not a coincidence. I said that a lot of times. I'm going to say it again. This is not a coincidence. You see it happening over and over and over. But to get to that point, it's got to culminate. It doesn't mean that every time there's low volume that there's going to be a breakout afterwards. It has to culminate to all these things coming together. That's what specific entry point analysis is. My strategy is about having all these elements coming together to one specific point, one day, where that's where you should be placing your buy based on a whole bunch of probability. I call it probability stacking, where you're putting all these elements together where the probabilities are very high for a successful trade. Now, here's the weekly. Remember, I said the weekly, you're going to see it on the weekly too. See, perfect. Looks beautiful on the
See those
weekly.
blue bars, all those are all big institutional accumulation bars.
That's just a classic cup with handle. That's all that is, just a big cup with handle. That's an O'Neill cup with handle. Now, Body Central, I was in the mall. It was around Christmas time, right over here in December. And I was with my wife, and there was a Body Central in there. And I walked in and I said, wow, this place looks interesting. It's real. The stuff was real youthful and it was all colors. And I thought it was, a great looking store. But whenever it comes to fashion, I asked my wife, and she liked it. And she said, yeah, it's a pretty cool store. This looks like, kids would like this. So I just looked up to see if it was a public company, and sure enough, it was starting to set up in a primary base. So it was right at this point, right here. You can see December, around right before December 25th is right here. Just a few days later, it was setting up in this pivot, and so I bought it coming out right here. I sold right into this rally here, so I was gone in like 4 days, but I made a nice quick little rip on it. This never went on to be a really big stock over over the long term, but a nice move in 15 months, up a double. Michaels, I bought Michaels here. I think if I remember, I think David Ryan and I were buying it on the same day right here. Came out real nicely a couple of days later. Wasn't very long, but 4 months to get 60%. Pegasystems, I bought this back in the mid 90s. I bought some here. I actually sold it into this first rally, and then I bought it back here. It got even way better. I mean, look at the tight price here. I mean, you can't get much tighter. So again, almost no variation in these few days. And then both were very explosive coming out of there. Phillips is one that because I tend to shy away from the cyclicals a lot of the times. I did not buy this one, but I watched it painfully as it set up, really perfectly. It broke out. I didn't buy it. I don't know if you saw this one too and passed on it, but
I did the exact same thing.
but it took off, and in 6 months later, it was up 130%. This is Phillips on the weekly, and just looking from that point, from here where it's set up is right over here. Nice move here, really nice move. It held a 10-week the whole time, and then it went into, this is a perfect example of going back to the beginning, the stage analysis. So we got stage one, it gets into stage two, breaks out, all the gain is made in stage two. Now you get this big, see this right here? That's not a VCP. It's too deep. It goes from $80 all the way down to a little over $45. That's almost a 50% decline. It's just a lot of volatility. And even though it tightens up on the right side here, this is what O'Neill calls wide and loose, just way too much volatility. And now you roll over here, and there's volatility all over the place, and you're now in the stage four. So you go stage 1, 2, 3, 4, absolutely perfect. This is a faulty VCP. So here's Shopify. I was in Shopify a few times, but I did not buy it here. But this was set up perfect. This is actually one that I did not see at the time. It was later on when I saw that I missed Shopify. I said, was there anywhere that I should have got on this thing? And then I looked back on it, I went, wow, how did I miss that? It was so obvious. If you take a look at the weekly looked beautiful. Here's another tip about these IPOs. When you get an IPO, and if you go back and you read How to Trade in Stocks by Jesse Livermore, it's a little book, it's like 100 pages, one of my favorite books on the stock market. He talks about how to buy IPOs, and he says once an IPO goes IPO and it corrects, that it's a relatively safe bet to buy it when it makes a new all-time high after the IPO. What I have found, I found that, which was in the 1920s and 30s, to be true to this day. But what I would add to that is that you want to have that occur coming from a volatility contraction pattern. And that's exactly what happened here. You come up this right side, you get into new high ground, and then it forms this first base. And so if you see a recent IPO, maybe it's an IPO a year, within the last year or two. And now it's setting up and it's going right into new high ground, all-time highs or close to it. Or maybe it's already in new high ground. It's up 30, 20, 30, 40% to new high ground. That could be a really big winner. That's just setting up in the very early stages. I always entertain those and
Yeah, and Mark, just
try
to
to
add
buy
to that,
those.
I made that point earlier. Sometimes these take time. This is a really good example, and I remember this one well because this was early 2017, if memory serves me correct, and there was a couple. This one, Alibaba, Square, ANet. There were a number of these stocks that had gone public, I think in 15 or 16, which was a little bit of a choppier, tougher market, similar to Ollie's. Ollie's was earlier, it broke out, I think, in 16, like you showed. But this was a theme, and there were a number of these that they'd been public for a couple of years, but then they started to tighten up on that right side. And I think Square was a monster. This one was a monster. So yeah, they're really powerful.
Yeah, here's another one. I'm not sure. Let me just see something here. I'm not sure how this got into the IPO. Maybe it was an IPO previously, but not sure how that got in here. Burlington, this is another one. This is another David Ryan. David Ryan actually brought this stock to me. It was setting up, and again, he was talking about how, so I don't know, something about it was a really cold winter, and people were going to buy more coats, and he had this fundamental thesis. And to me, I said, okay, man, it's coming out of a nice pattern. I'm going to buy it here. Sounds good to me. We bought it here coming out, and it worked out. Over the next 4 years, it made a nice move. But you can see here, you see how, again, you look to the left for traffic, you look for that supply. It bumped against this area, and see it came off each time, came off hard here, but each time it's coming off less and less and less. And you can see the line. This is what Livermore called the line of least resistance, where you get that supply line, but then it tightens up into that supply and it quiets down. That tells you that that supply has diminished, has stopped coming to market. And now your chances for explosive price action are the highest out of any time in this price action here. The chances for explosive price action and for a big move are right there, not over here, not here, because it didn't tighten up yet. It didn't give you that indication. Now it's giving you that indication, and it's gone through time. These iterations, these tightenings, these volatility contractions are telling you that there's less supply. Each time the supply is diminishing and diminishing and diminishing until finally it quiets down to where you have that low risk entry point. Again, there's a very good fundamental reason behind what I do and how I do it, and this is just this is building on work from Livermore, from Richard Love in the 60s and 70s, from O'Neill in the 80s and 90s. And then, I'm sort of like the next generation and taking this to another level. And I'm sure there's guys out there that are, learn from me, and certainly Mark Ritchie's one of them, and other people that have read my books, that they'll take it to another level, and there'll be observations that maybe I'm missing, or there'll be some kind of new tactics. The thing is that, we've tried to look for everything, because we look at history and my own 40 years of anecdotal evidence. And what I find is that I'm not doing really anything different than Jesse Livermore was doing, or Love, or O'Neill, or Nicholas Darvis. We're all doing the same thing pretty much. It's really a timeless approach. It just takes a lot of time to get the skill to put this all together. You talked about LinkedIn, Mark. Here it is. LinkedIn. I bought LinkedIn right here. I watched it IPO. I didn't touch it. It had a huge decline, just like Facebook. Came all the way back. Again, look how it forms the line of least resistance. See, it comes back here, and each time less supply, until finally it really tightens up. And this meets a couple criteria. First of all, it goes through and you got the nice volatility contraction, right? Well, and also it meets the Livermore rule. It's making an all-time high here for the first time since here's its IPO. It came back right up to that level, but could never make a new all-time high. As soon as it makes that all-time high and comes to that out of that VCP, it just rips off. It comes right out here. I was actually on CNBC, and I right after this weekly bar here, I gave this stock on CNBC. It was funny story. Maria Bartiromo. I went on with Tyler Matheson, Maria Bartiromo, and prior to going on the show, they had said to my the person who booked me, said, we want Mark just to give us his one pick, which I hate when they ask for that. Just give me his favorite stock. What's the one stock that he would load the boat on? So I was like, all right, I'll do it. And so I go on there and they're like, hey, Mark, you're the market wizard. What is that one stock that you would pick right now that you would tell everybody to buy? And I said, well, that one stock is LinkedIn. I said, it just took off and broke out, and it's up real big on earnings. This came out on earnings. I said, and that's not your Aunt Betty buying there. Those are institutions piling in. So the future looks good for this stock. And Maria Bartiromo completely blindsides me. And she goes, oh, come on, Mark. You're not telling people to put everything into one stock. That's ridiculous. I was like, damn, they set me up and sent me to the wolves there. But anyway, it ended up working out. Anyway, at this point right now, we're going to take a quick break, and then we're going to come back and we're going to talk about the velocity play, the velocity opportunity. We talked about the magnitude opportunity, which is the recent IPOs, and how you're getting in at the earliest point that you could subsequent to the IPO. Now we're going to talk about something that is close to Mark Ritchie's heart. He's done a lot of work and come up with actually some improvements upon some observations to be able to improve the way you play what we call the power play, which is built on the height tight flag, the O'Neill height tight flag, which goes all the way back to Giller and Love, and even to a certain degree Livermore. And we'll talk about that when we come back. So we're going to take a break and we'll be back here in just shortly. Okay.
Okay, guys, that was the failure reset, pivot and base failure reset, as well as the primary base magnitude play. We're going to take about a 5-minute break here, get up, do some jumping jacks, get the blood pumping. We're going to be coming back with one of my favorite sections, which is the power play. And we'll do that after a 5-minute break. Stand by.